Good afternoon, TSuffish here with an update on what we've seen over the past couple of months, specifically Q3 in the markets. And if there was a story or a takeaway from Q3 2015, it was the return of volatility. Looking at the numbers for Q3, the U.S. stock market, as represented by the S&P 500, was down about 6.5%, which is actually the worst quarter for stocks in about 4 years. Compared to some of the other moves around the globe, though, that was actually not that bad. If you look at the broader market of developed international stocks, they were down close to 10%, and if you get into the riskier emerging market stocks, they were down close to 18%. Looking at some of the other asset classes, bonds actually did what you typically expect them to do in a time of volatility. Bonds are up about 1%. Commodities, broad commodities, so energy and metals and the soft commodities were down about 14%, and then obviously one of the sore points and weak sectors over the past year has been oil, and oil for the quarter was down almost 25%. So volatility is back. There was a little snippet during the height of the volatility in late August, early September. And that was, if you looked at the first 6 months of the year, the U.S. market had only 2 days where the market experienced a 2% move. In the latter part of August and the early part of September, we were having a 2% move every other day. So we went from nearly non-existent 2% moves to half of the trading days had 2% moves. So volatility really has come back. Now, if you broaden the lens and look at what we've been through, a rough starting point or near the high, the Dow was at 18,000. We came down to about 16,000, and we're now, as of this taping, back to 17,000. So 10% decline, top to bottom, and we've retraced about half of that. So from the highs, we're down roughly 5 or 6% right now. So volatility is back. Why did this all happen? Well, during Q3, we had a couple different things happen, specifically China, which has been in a slowing trend for the past couple of years, experienced an acceleration of that slowing. And looking right now at the Chinese economy as a whole, so not their stock market, but their economy, as of the most recent quarter, it's growing at about 7.3%, which actually, in comparison to our economy, is very rapid growth. But compared to what China is used to, that's very slow growth. So 7.3% for China is actually the lowest reading since 1992. Going back over that time frame, the average growth of the Chinese economy has been 10%. So China is slowing, and China is obviously a big part of the emerging markets. It is an absolute value big economy in the global economy. And China is very meaningful to commodities. So one of the reasons why we've seen a downturn in the price of oil, downturn in the price of other industrial commodities is the slowdown in China. So they are really tied together. And actually, if you look at charts that show the correlation between China growth and commodities in general, there is a very strong correlation between those two, not surprisingly. So China's slowing down, one of the causes for the market volatility. Second is a little bit of weakness here in our economy. So if you look at employment and job creation, that has been one of the strong points for the U.S. economy over the past couple of years, and the past 2 or 3 employment reports have shown some weakening of the good trend. So the most recent one just came out, most recent employment report for the month of September came out this past Friday and showed job creation of 142,000 jobs for the month of September. And that was actually quite disappointing relative to what investors were looking for and expecting. So when we get those job reports, there are typically 4 data points that we look at: the number of jobs created, the participation rate, which is the percent of working adults, working age adults who are actually working, the hours worked, and wages or wage growth. And on all 4 of those measures, the employment report was a disappointment for the month of September. So a disappointing September on top of a disappointing August, and the combination of those two plus China just has investors a little bit worried. Again, broadening the lens a little bit, looking back at employment in 2014, For most of 2014, monthly job gains never dipped below 200,000 jobs, and most of those reports were closer and north of 250,000 jobs. So dipping from that level down to 142,000 for the most recent month is a disappointing number, and hopefully a trend that does not continue. Finally, we can't really talk about the market without mentioning the Fed. And Fed focus has been something that we've talked about and investors in general have focused on for really years now. And for most of the past 5 years, the focus was on the different quantitative easing programs and the stimulus that went along with that. The talk recently, say the past 12 months, has been more focus on when the Fed is going to get out of the stimulation business. And the Fed right now is, based on the weak employment report and on the volatility that we've seen in the market coming out of, or because of what we've seen in China, most recent expectations regarding the Fed is a hold off on any move till March of next year. So if we turn the clock back just a few months, there was a really strong expectation that the Fed would do something during 2015. That seems to be off the table, and it's now pushed out to 2016 before the Fed moves. And there's a couple issues at work there. So the Fed has been stimulating for a long time. Rates are at 0% for the Fed funds rate. We have been believers that the Fed should have moved back to a more normal stance at some point in, say, the past year or so, because employment gains have justified and proven that the economy has come back to an extent that we don't need a 0% Fed funds rate. The one fly in the ointment, though, is that inflation has really weakened over the past 12 months. So the Fed has an explicit target of a 2% inflation target rate, and over the past 12 months, inflation has basically gone down to the zero level, plus or minus a little bit. And with that backdrop of really low inflation and inflation that's below the Fed target, Bernanke and now Yellen have been really reluctant to do anything with the Fed funds rate. But we'll soon find out. Right now it looks like it's a 2016 event. So with all of that said, looking out over the next month, it's now the beginning of October. We have earnings season for Q3 coming up any day now and continuing for the next month, so we'll find out what corporate America has done in terms of top line, bottom line from the companies that we invest in, and expectations there. If you strip out energy, which will not be good, if you strip out energy and materials, the expectation is for low single digit, maybe 2 to 3% earnings growth from the rest of the sectors, which I think will be good enough for investors. So earnings over the next couple months, and then continued focus on the Fed. And the next time we talk, we'll likely give a recap of both of those points. Thank you.